Good evening, ladies and gentlemen, and welcome to our class on profiting in gold and oil. Now, tonight's class is sponsored by one of the world's leading Forex providers, and that's FXP Markets, www.fxp Markets. They are one of the world's most advanced Forex providers. When you use their platform, they offer very extensive education. They have ebooks, videos on demand. They offer you daily signals, all kinds of technical analysis to make sure that you can trade successfully. They also have one of the most advanced but easy to use web trader platforms, or you can download their MT4 platform or use their mobile platform. So when you trade with FXP Markets, you are trading with the best of the best. Now, they also provide you up-to-the-minute signals live right on the platform. So while you're trading, you can see exactly what's happening in the market. You can see the up-to-the-minute analysis. You can see all the indicators and follow their signals if you wish. So tonight, we're going to be talking about two big assets. That's gold and oil. Now, most people just talk, they heard the word gold and oil, let's trade gold and oil. Well, you know what? They both fall under the term commodities, and they can both be traded using CFDs, ETFs. There's many ways to trade them, but gold and oil are the exact opposites of the scales, because gold is an investment security, and most of the gold around the world is owned by central banks or large investors, and it's not bought for speculative reasons. And even the big investors that are investing in gold are not speculating. They're buying gold for long-term, slow moves, as opposed to trading gold. Okay, because when we come to trading gold, gold is traded quite a lot, but nowhere near what people assume it is. On the other hand, oil is the grandfather of them all. Oil is the largest speculated commodity in the world, okay, because oil is traded by speculators, thousands and thousands of contracts per day. So we have to kind of separate them when we're going to look at them, because the factors that affect them are very unique and separate. So, but before you can think about gold, there are several important points to remember. Notably, the fact that it is a safe haven asset. Okay, a safe haven asset is where people go, or investors go, in the time of market upheavals, geopolitical risk, high inflation. Okay, this is where people go for safety, as well as for investing. But this means that gold is the go-to asset when the equity market's sour. So normally, like we see, equity has been trading very high in the US, but gold has been climbing. Gold had climbed yesterday, or has been climbing over the Federal Reserve decision. Okay, now we have August almost out of the way, and we're moving into September, but gold is trading just under $1,300. Now, why is gold climbing when stock markets are near all-time highs? Now, since capital typically flows into equities, treasuries, and fixed income bearing accounts, or gold, there's a massive redirect of resources when a risk-off approach is adopted to equities. While you don't eat it or drink it, people are attracted to gold. It's been used as a currency because it doesn't corrode, and the material allows for some absorption of light, creating the yellow gold. The value of gold fluctuates from moment to moment, as it is now traded on public exchanges where its price is determined by supply and demand. The reason people buy or sell gold, creating demand and supply respectively, may be pure speculation, acquiring it, or distributing physical gold, or hedging, or commercial applications. But remember, gold has no value. It has absolutely no value except what we assign to it. So if you have a preference to trade gold and desire to do so, then essentially you must develop your trading mindset so that you can implement quality decisions over a considerable period of time. The importance of mastering the skill cannot be understated. This is because you will need to react in a professional manner to the many involved conditions that the gold trading environment is capable of generating. And since gold is very reactionary to headlines, to news and events, it's very easy to get sucked in to the emotional side of gold. Under such circumstances, you will not possess the luxury of allowing your hunches and gut feelings to influence the process of your trading decision making at all. Instead, you will need to remain focused at all times without allowing yourself to become distracted by any internal or external stimuli. Expert consensus explicitly stress that trading gold successfully requires a business type and professional attitude. As such, your primary objective must be to ensure that your account balance is fully protected from high levels of volatility that gold trading can generate. By doing so, you then must maximize the stress levels or minimize the stress levels, okay? Because gold moves in large numbers. And this is what not just somebody, everybody needs to remember. Gold isn't like equities, okay, that move slowly throughout a day. Gold isn't like currencies that move a couple pips in a day. Gold can swing $25 in each direction. That's a big swing in a day. Okay, so you have to be able to cover the swings of the market without getting margin calls. Now, since the dawn of time, gold and silver have been recognized as valuable. And even today, precious metals have their place in an investor's portfolio. But which precious metal is best for investments? Because you also have to be aware that gold, especially gold, is bought in many different fashions. And just watching how gold is trading in the futures market doesn't necessarily tell you how it's trading as an ETF, or how it's trading in the spot market, or how it's trading in the gold scrap market, or how it's trading in the gold coin market. Because gold is traded many, many ways, and you have to watch. So if you're just simply watching the volume of contracts for a future, and you're not watching how much coinage is being bought up, you're not watching how much, iShares is selling, or SPRD, you can miss the market moves by underestimating the activity. So gold is unique for its durability, malleability, and its ability to conduct heat and electricity. It has some industrial applications in dentistry and electronics, but we know it principally as base for jewelry or as a currency form. There's no other demand for gold. Okay. Gold isn't like oil where it's being used up. And so the more manufacturing you have, the better the economy is. The more oil we're burning, the more cars we sell. You sell 1 billion cars, it's not going to increase the amount of gold being used. So the value of gold is determined by the markets 24 hours a day, 7 days a week. Gold trades predominantly as a function of sentiment. And you have to remember that. It trades predominantly as a function of sentiment. Its price is less affected by the laws of supply and demand. Because there's nowhere out there that you can actually calculate how much gold is being mined. There's no number out there that tells you how much gold is in production. There's no inventory, weekly inventories, or there's no production levels like come out of OPEC. Okay. This is because new mine supplies is vastly outweighed by the sheer size of above ground hoarded gold. Some estimates of what Indians own in gold jewelry in their homes is unbelievable. The amount of gold held in vaults under New York City, the amounts of gold held in the Russian central bank, the amount of gold that used to be held at Fort Knox were huge, huge amounts, but there's no actual tabulations of these. Now there's estimates. You can go back and see what the Bank of Russia is holding. You can see what the Bank of Japan is holding, but there's lots of private investment vaults. There's lots of other things. There's gold all over. Like I said, I think somewhere I read once that there's more gold hoarded by the Indians, citizens of India and the Indian temples than all the gold in the Russian vaults. Okay, it's just huge, vast amounts of gold. So it's really difficult to put it simply in the amount of a supply and demand. Okay. So to put it simply, when the hoarders feel like selling, the price drops. When they want to buy, new supply is quickly absorbed and the gold prices are driven higher. Okay. But it doesn't really have an effect on the market. Over the last few years, India has been doing all types of things to move gold out of these homes, move it into the market and control, get this wealth out of where it's sitting. They're not trying to take it away from people. But when you have wealth like that sitting, not working, it's worrisome to the government. Now, gold is more reactionary. You have to know the factors that affect gold. Okay, so gold is affected when banks and money are perceived as unstable or political stability is questioned. Gold often has been sought as a safe haven. Anytime you see an outbreak of war, anytime you see a conflict in the Mideast, you'll see gold. Now, it doesn't react violently sometimes, but when there's craziness that happens, you can see it react violently. Okay, it reacts more to central bank action, but anytime, like when Russia invaded Ukraine, not only did oil go up, the next morning, it has happened on a weekend, the next morning, gold prices went through the ceiling. Because lots of people were moving their assets into gold. Gold is easy to protect. Gold is easy to transfer. It's heavy. But if you need to get out of your country quickly with a couple gold bars and you don't want to take all, your stocks and bonds, which can become valueless depending on what's happening with the central banks. Now, inflation also has a major effect on gold prices, primarily U.S. inflation, but also if inflation around the world is starting to ease back up. Now, remember, we've been dealing with very, very low inflation rates. In fact, worrisome low inflation rates around the world. But as inflation rates are starting to move back up towards 2%, if we start seeing it get over 2%, you will see a direct price on gold. Okay, because when inflation gets high, central banks must act. And gold doesn't go up in value, but gold stores value. Okay, and that's the nice thing about gold. So when real rates of return in the equities, bond, or real estate markets are negative, people regularly flock to gold as an asset that will maintain its value. So when you see the stock market falling, or you see housing prices going down, when you see this happening, you should see gold prices climbing, because gold doesn't generate any money. If you had $1 million and you put it in gold, or would you put it in treasury bonds that are reaping 2, 3, or 4% return? Gold doesn't issue a return. Gold has no interest. Gold doesn't make you money, except if the price of gold goes up. But this is when you're talking between investing and speculating. Speculating is a whole different world than investing. But most of the gold around the world is either held by banks or speculators, or by investors. Then you have the little portion that makes it go up and down, which are the speculators. Okay. Now, war and political upheaval have always sent people into gold hoarding modes. An entire lifetime's worth of savings can be made portable and stored until it's needed to be traded for foodstuff, shelter, or safe passage to a less dangerous destination. So let's take a look at the options of what you can do or how you can invest in gold, because anyone can start trading in gold or invest in gold. Gold and silver can be easy, fun, and profitable. Anyone can learn how to start buying gold or silver as a physical store for wealth, not as speculators. Okay, so you can buy gold coins, you can buy Krugerrands, you can buy spot gold, you can buy ETFs. There's many ways that you can buy gold to store wealth. Okay. This precious metal is both beautiful and solid long-term investments. However, like any activity, the process of buying and selling and holding gold and silver involves certain nuances that are important to understand. For example, when you are armed with a baseline of knowledge about the gold market trends, different ways to buy gold and silver, values of gold and silver coins, and more, you will be a more informed investor. Okay. Now, it's important that you understand, because all of these have ways to affect the markets. And since most of us here are speculators, when we can see a drive in ETFs, exchange traded funds, that can also have a price on the value of gold that you're trading as a gold CFD. And ETFs are a convenient and liquid means of purchasing and selling gold, silver, or platinum. Then there's common stocks and mutual funds, which most people don't think about a way to buy gold, but you can buy gold by owning shares of mining companies. You can buy gold by buying shares of iShares or SPRD, okay? Unless you're aware of how mining stocks are valued, it may be wiser to stick to funds with managers. So there are all kinds of funds out there that only buy gold or only buy precious metals, some that buy multiple types of gold. But believe me, the worst investment you can make in gold is spot gold and jewelry. Because what you pay for gold and jewelry has nothing to do with the real market value. Then you can buy gold in the futures and the options. Futures and option market offer liquidity and leverage to investors who want to make big bets on metals. The greatest potential profits and losses can be derived from this product, and this is us. But then you can also buy bullion. Coins and bars are strictly for those who have a place to put them. Certainly for those who are expecting the worst, bullion is an option. But most of us don't live in in economic situations or geopolitical situations where the worst is going to happen. But if you live in a society or a country where it could, war could break out, governments could take over things, bullion is less liquid, but it's easier to move. And when you have to and you have to run overnight from your country, and that sounds horrible, but this has an effect. It's easier to have gold bullion. You can run, it's got a value anywhere, you can change it in wherever you go for currency or exchange it for food or lodging. So you can also buy certificates. Certificates offer investors all the benefits of physical gold ownership minus the hassle of transportation and storage. That said, if you're looking for insurance in a real disaster, certificates are just paper. Don't expect anyone to take them in exchange for anything. Now, that said, it's not necessarily true. If you have a certificate from one of the biggest issuers in the US, okay, they're going to be good anywhere around the world. But the fact is, if you're having to run and watch your tail, it's very hard to get food or lodging for a piece of paper that says you own something. But these are just the ways that people buy and hold on the gold. Lots of very wealthy people buy certificates. You'll find their safety deposit boxes packed full of these certificates of ownership of gold because they don't want to store gold. But they like having the certificates that say they own 2 bars, 5 bars, 12 bars, 7 bars. And each one of the certificates are worth something. Our love for gold shows no signs of abating. Bullion dealers have sold coins, gold bars, Krugerrands by the bucket load, while people have invested in gold exchange traded funds in record numbers. A number of websites have joined the gold rush, offering to take unwanted gold jewelry off your hands. The question is, which is the best way to make a profit in gold? So you have a choice: ETFs, electronically traded funds, futures, or CFDs. Today, the most popular, and especially for those in our audience, is CFDs. CFDs are the least complex speculative item. Because when you're trading futures, you have to understand the dates, the times, when they're going to expire. Where CFDs move in the same position as futures, but they don't have a time quotient. The spreads are virtually the same. And sometimes CFD tax scenarios are better, but you have to understand your own tax scenario and whatever country you're in and how the taxes affect your country. But most of us today, unless you have huge, huge accounts, okay, because futures, okay, or in the commodities market, have some advantages, but only to those having huge accounts that are trading huge dollar amounts, because the difference in the spread to the commission to the cost of the overhead are virtually negligible. And when you come to the difference between futures and CFDs, most of us who are investing a couple $1,000s, it makes pennies. Okay, now let's talk about what's happening with gold, because it is affecting the price of gold. Now, the FOMC came to gold's rescue overnight yesterday as the yellow metal unwound what was potentially a profit-taking day and rose almost 1% to close in New York at 1261 from a 1250 opening. Gold climbed $11 yesterday. The FOMC's admission that inflation remains subdued and that the balance sheet unwinding will start soon saw the US dollar red carded, or in other words, it dropped. And both Forex and the metals market were able to benefit. The dollar was way down. That means all the foreign currencies were climbing up. So when the dollar goes down, gold goes up for 2 reasons. First of all, this took interest rates or additional interest rates and might have moved it off the table a little bit. At the same time, when the dollar goes down, it makes the euro more valuable, the pound more valuable, the Japanese. So it makes gold, which is sold in dollars, cheaper to foreign investors that have to. So if you're buying with euros and the euro's gone up to 116 or 117, gold's, and the dollars come down and you can buy gold at a low point, it's very attractive to you. Because not only do you get the benefit of the gold going up, your purchase price is reduced because the dollar is down. So the bullish sentiment surrounding gold is back up, has jumped in the investors' demand. Money managers boosted their long positions U.S. futures for the highest in 4 weeks. But we can see on the chart here, look at that climb in gold yesterday. Gold jumped from 1250 all the way up to close at 1262.79. That is a huge climb. Okay, and it was a predictable climb. Gold to trade steady on safe haven demand as uncertainty continued to fuel. Amid uncertainties over geopolitical tensions over North Korea, now the UK Prime Minister decided to go to snap elections in 2017. Also, these things help push gold. That gold's been steadily climbing over the last few months. This election with this bear miss by Theresa May and the stress out of North Korea have both had effects on gold. So here we currently have a gold chart. We can see gold was moving into a downtrend not so long ago, fell all the way down to 1215. And then we can see the steady uptrend of gold moving all the way up. Now, gold is trading at the 1300 level. We have a very good support level at 1277, another one at 1272. So a pullback to those prices could offer very good buying opportunities for gold. We saw a very nice triangle developing. Okay, and when we see gold go into that triangle, we could easily use that to develop a buy and a sell point and watch for it to break out. Okay, so we can use, and gold is trading actually at this point, gold has been trading, there's been very good technical indicators on gold. We're going to go look at a live chart in a minute. But regardless of where price ends up on gold, identifying a symmetrical triangle can allow traders to choose from a variety of trading strategies. Now, if you look at gold on a monthly basis over the last year, gold in the end of June, towards the end of July, is forming a beautiful head and shoulders pattern. And now we probably have the last of the shoulder, and we can start making some representation from there. Now, the Fed said that it would like to begin shrinking its balance sheet as early as this year. Many market pros expect some action on the balance sheet around December meeting or early 2018, after it raised interest rates in June and then predictably in September again. So here we can see this beautiful triangle developing for gold through June, and it continued on through July. And we're sitting here, and now what we're seeing is a beautiful breakout of this candle, of this triangle. Now the breakout should eventually push gold up to 1350. So this is what we see developing in a long-term movement. Okay. We also see the development of this head and shoulders pattern. And we can also take a look at the crossovers between the moving averages. And we see a crossover between the 200 and the 50-day moving average. And we see gold sailing straight up. So this is supporting gold's move upward. So we should see that continue. But this is only speculation, because I would say as we hold that close to that 1300 level, it's going to be a very difficult level to break, because we're going to see a bounce off of there many times. Okay, and we're going to see if the investors can get up the gumption to break that all-important resistance level at 1300. Now, oil, on the other hand, is very different. Very, very different. Because oil is basically restricted to the Middle East and the US. Granted, when Canada had its wildfires, I mean, that stopped the production of oil, and Canada's a big producer of oil, and for the Canadian economy it is. But even when you have a little ripple in the overall global supply, it can push price upward. Okay, because the price is based on the production from around the world. But at this moment, we have excess production out of the Middle East, and we have U.S. shale producers producing more and more and more. You know, when we started this mess, we didn't start, when OPEC started this war against U.S. shale producers 2 years ago, and they let these prices fall from $89 all the way down to the low 40s and kept their production up. They were trying to push shale producers out of the marketplace. And this is what you have to understand in today's trading or speculating. What happened was, once price was below $50, it became not profitable for U.S. producers to keep investing and keep developing new projects. And OPEC was less concerned with short-term increases, and they were trying to cut out long-term projects, because if they can take some projects off the charts for the next year, the year after, the year after, the year after, okay, they're going to see a decline in U.S. production. And that worked for a while. Okay, we saw all this layoffs from all the U.S. producers that cut back into everything else, but then we saw prices stabilize, and we saw prices stabilize in the 40 to 50 range. U.S. shale producers were also, because people forget how agile the U.S. drive is, okay, especially U.S. producers, oil producers. They managed to find a way in the one and a half years to double the shale production without doubling the expense of producing it. So in other words, they were able to reduce their production costs by almost half. This made the $50 price or $45 price very attractive. And what's happened is the shale producers now, by sinking 2 simultaneous pipes, okay, which reduces their cost tremendously, produce twice as much. Well, this has killed OPEC, or killed the price, because no matter what OPEC does, they can't drive up the price. And this is what's happening in the markets at the moment. If it wasn't for the amount of production, the amount of backlog, the amount of excess inventory floating around the world, and the increase in U.S. shale production, just a little wiggle this last 2 months with Qatar, just to increase stress out of the Middle East, would have or could have pushed oil prices skyward. But they didn't, because the shift is moving away from the Middle East. Even though there are big producers, okay, the U.S. has now started allowing exports a year ago, and they're starting exporting all over. It used to be that the U.S., you couldn't export oil. It was all consumed within the U.S. And that was fine, because they needed it all anyway. Now they become a net exporter. They actually produce more than they need for the U.S. Okay. So this has shifted a lot of the economic thinking. We see all this happening with Saudi Arabia, and they're shifting government. They're trying to shift away from an oil-based economy. They're going to take their oil company and take it public, and they're starting to build this huge fund so they can become an investment warehouse as opposed to being an oil producer. But how does a barrel of oil from Saudi Arabia or Iran determine how expensive gasoline is? That's because the barrel is part of a crude oil market, which has a major effect on gas prices. Crude oil is the black stuff that comes out of the ground, also known as petroleum. It's made up of a variety of elements like carbon, hydrogen, sulfur, and originates from the remains of animals and plants that existed millions of years ago, hence the term fossil fuel. Now we have two what we call benchmarks. These are the two major oil types that control the market prices. This is what we look at when we control, because there's all types of variations that are sold from country to country, producer to producer. They're all very similar, but their weights are slightly different. So we have two standardized benchmarks. And these are called North Sea Brent oil and WTI, West Texas Intermediate Crude Oil. Now, West Texas Intermediate Crude Oil is an oil, it's a sweet grade oil, and is typically extracted and refined in the United States. Brent Sea crude oil comes out of the North Sea. Okay. And these are the two biggest, so they become the benchmark. And this is what sets the prices. Now, both of these oils are typically reported together, but sometimes their prices move in opposite directions. Now, besides the basic supply and demand model, the world's political climate heavily weighs into the international price of oil. There are a handful of major players, the United States, OPEC, and Russia. Mainly, but more than 100 countries around the world are consistently sending products to the worldwide market. Now, because the US, OPEC, and Russia are the main suppliers, what we get are little blips. When we have things happen in Libya, when we have things happen in Kuwait, when we have things happen in South America, it's only because there are temporary disruptions in supply and demand. When we have tensions in the Gulf of Hormuz off of Iran, okay, it's not going to stop production around the world, but you can't just stop ships that are floating around the world with oil and reroute them. It takes a while to get them rerouted. So it may take 2 months to get the oil flowing in, to get it where it's going. So what it does, it drives up oil prices. Whenever there's a little shift in the markets, in this shift of supply, okay, it can drive prices through the ceiling. You know, it's like when Iran was in the market, out of the market. You know, when they had the embargo, they didn't have the embargo. The world has right now more than enough oil that it knows what to do with it. We're drowning in oil. But it's just, I mean, you don't want to pull up to your filling station or call your heating oil supply guy for him to say, oh, we have a 2-month delay, so you can't get oil for 2 months from now. So you say, I need oil for my heat for the winter. I need it delivered next week, or I need gas for my car. Not, okay, I can get, so you're willing to pay more because the supply is scarce, even though you know in 2 months from now there's going to be tons of it. And this is what really drives the price. Now, the U.S. has seen production increases rapidly in the last several years, and OPEC, which comprises of 12 countries from the Middle East and South America, has decided not to stymie production. Russia has been causing a stir with the annexation of Crimea and explorations of the polar region, while China is also beginning to emerge as a potential major producer of oil as well. Now, China is a major consumer of oil. And a lot of oil is used in China, but they are slowly developing their own production. And this will have a shift in the marketplace. But right now, they're not a big player as far as producing, but they're a big player as far as consumption and demand. Now, the way oil is traded on financial markets has a massive influence on its price. Speculators invest in oil futures, essentially bet on how much oil will cost at a later date. And this in turn affects how other people think oil should be priced. It also affects how much oil the petroleum companies will release to the markets. Okay. Now, government regulation has a big effect on oil prices. Recently passed rules on sulfur content could raise the demand for sweet crude oil, a type of crude oil with less sulfur, but sweet crude oil is less common that's WTI in the US, than other types of oil. And laws aimed at preventing climate change, which Trump threw out the window, will likely raise the price of energy too. Taxes on gasoline can also affect prices. Now, one of the biggest demands for oil is the gasoline to run trucks and cars. And gasoline prices are very closely monitored, and oil prices directly affect the price of the oil at the pump. Now, the US, one of the reasons you haven't seen much stuff out of the US over oil is because it's keeping oil prices down. When oil prices stay down, gasoline prices stay down. When gasoline prices are low at the tanks, consumers are happier. They have more money in their pocket at the end of the month. They spend more on retail, and it helps the economy turn around. So the US hasn't done anything to help the producers in the US, and hasn't worried about the layoffs or the cutbacks or the financial difficulty to the private production, because it's overall good for the US economy to have low oil prices. And we have to watch this closely, and you have to, before you can speculate on oil, you have to understand all the little intricacies. Because like summer, we're now in what we call summer drive time. Summer drive time is when most gasoline is consumed, not just in the US. All of Europe goes on vacation, especially England. They're all driving all over the countryside. So they're consuming more gasoline than they normally do, or petrol. Now in the US, we have two ways that they make gasoline. We have summer oil and summer gasoline and non-summer gasoline, which most people don't know. And if you're driving a car, you don't even know the difference. But in summer months when it's very hot, they produced a gasoline that drives just as well, but it's produced differently. So the manufacturing plants cut down or cut back in like March or April, and when they shift over to the production change to start producing summer gasoline. Summer gasoline uses less diesel or less petroleum also. So you have to be aware of when these shifts are occurring, because this sometimes has an effect on US inventories. And that can throw you out of kilter if you don't understand the markets. Now, other countries have strong supplies, including Russia, Venezuela, and the US. The oil found in Texas in the early 20th century resulted in a significant economic boom for that region. In fact, North America is currently the world's second largest oil producer. Now, groups like OPEC monitor their supply and can ration out as they see fit. Now, similar to the stock market, which involves trading investments in various companies, people also trade in commodities in the financial markets. They purchase futures, a sort of bet on whether a commodity will increase in price at a later date. Once locked into a futures contract, the buyer will get his or her commodity at that price, regardless of whether the market prices change or not later down the road. These futures are traded on the New York Mercantile Exchange, as well as the International Petroleum Exchange. Now, speculating in futures of oil. Now, a futures contract requires 1,000 barrels of oil. So if oil is trading at $42 a barrel, and you have to buy a contract at 1,000 barrels, that means your minimum investment is $42,000. Okay. Even if you're using leverage and margin, you're looking at a big risk. Now, oil can move $1 or $2 a day. It normally doesn't. It moves in cents. But every time you're sitting with 1,000 barrels, if oil moves $1, it moves away against you. That's $1,000. If you have leveraged up 100 to 1, that's $10,000 you can be out of your pocket in no time at all. Now, CFDs are an easier way to trade oil. Hold on one second. Something just shut down for me. Okay. CFDs are an easier to trade oil because then you're just simply trading on the difference in the value in the current marketplace. Commodity traders have been getting better. Commodity trading has been getting bigger than ever in recent years in response to the dot-com crash in the early 2000s. Some financial analysts say it's more of a certainty than trading in places like dollar or gold. However, As a result, speculations come in the shape of price of commodities like oil more than ever before. We have a lot more speculators. We have oil prices go up and down with huge volatility and huge volume every day. It's the granddaddy of them all. It's the biggest traded market in the world. Now, I'm going to jump towards the end because we want to look at where oil is right now. Okay, so because we're almost running out of time. Just give me 1 second to get up to the slides we need for. Okay, so since the drop in crude prices began last year, American oil industry has responded with remarkable speed, dropping more than half its oil rigs from just over 1,600 late last year to 800 by April. The transformation has not been without its share of pain. Oil companies have announced layoffs of more than 100,000 workers since November. But as large companies take advantage of bargain basement prices to gobble up the assets of weaker companies, the industry is likely better capitalized to expand production in the future. And that's exactly what they did. So, oil prices are expected to remain low over the 2015-2016 period and then into the 2017 period. Okay, and we're expecting oil to stay where it is. Now we can look at the two oil benchmarks and we can see where price has been moving steadily. Okay, so the short-term outlook is for oil to stay down at the current price of where it is trading. But it's a safe bet that investors are getting increasingly tired of the conflicting forecasts for gas and oil. Every day you see another big investment house calling oil to go up or down. It's going to be $85 by 2019. Somebody says it's going to go as low as $20 this year. They change their projection as fast as we change our underwear. Okay. So from a technically standpoint, West Texas Intermediate crude futures are trading just shy of the November highs. They've been rising lately, okay, encouraging continued gains in crude oil, and we see the 50-day and the 200-day moving average trending towards a price action. Although the long-term moving average continues to trend lower, the 50-day moving average is acting as support. Okay. So much was made of last night's oil's positive price action, but in fact, it has left me somewhat underwhelmed. So as we can see on the charts, okay, oil has been steadily climbing, but it's staying well under the $50 bracket for West Texas Intermediary, slightly over 50 for Brent oil. It is trading near the top of where its level is. This is predominantly not on increased demand, it's not on increased supply. It is on the lower dollar. Oil, again, is traded in dollars. And therefore, when the dollar weakens, oil prices are more attractive to speculators that are attracted in foreign currency. Otherwise, there is no other reason, because even though the weekly crude oil inventories can spark volatility, the world is still filled up with oil. We still have tankers backed up all over the world, just parked in the oceans, packed full of oil. Now, right now, oil could be a very good opportunity to sell on peaks. If crude oil touches anywhere near $49, it would offer a great sell opportunity. If Brent oil goes up as high as $51.50, it would offer a great sell opportunity. If they bounce off and come lower, okay. But right now, they're offering a very good opportunity to sell on tops and buy on bottoms, because they're overstated currently because of the reaction to the US dollar. We can see the climb this week. We saw a $3 climb in oil prices, but we see it tied directly to what? The Federal Reserve and a weakness in the dollar. There's been no economic changes, no cut back in production. So this is where we're sitting with both of them. So let me pop up some live charts on the screen real fast, and then we're going to go. But we can see gold moved into this beautiful triangle, okay, and then broke out just a little while ago, and we see gold coming back up to retest the 1296 resistance level. So this is where we're expecting gold might want to go. So as we can see, it's up to 1260. It had gone as far as 1264 yesterday or earlier today, but that's where gold is sitting. Okay, 1300 is going to be a key level for gold. If you see it approaching 1300, it might offer a very good sell opportunity. Oil, on the other hand, we can see it climb back up this week, but we see it bouncing off of the channel and coming back down to somewhere around the 43.55 range. We might see it climb back to the channel top, back down to our original target, and we might see it do a 5 pattern up and down, but stay within the current trading channel. Now, this is a more long-term chart, okay, but this is where we're expecting that it might move to over, not in short term, this is what we're expecting over the next several months. This is where we're sitting right now today with oil. And oil is up here. We're expecting to come right back into this channel. Okay, so you have some opportunities in both oil and gold because they're both trading at uneasy highs. But keep an eye on those, okay? And if you want, go to www.fxp Markets, open up a demo account, and try trading these. Try putting some longer-term trades in there. Try doing some limit orders. Try testing some strategies. And good luck to you all. Thank you very much for joining us tonight, and have a great trading week.